Last week I spoke to you about a paper by two economists at the New York Federal Reserve who argued that the current slowdown in the US economy was not a conventional recession, but it could be better modelled as the effect of a very large natural disaster. And they used data from the Hurricane Katrina disaster in New Orleans on unemployment, particularly initial jobless claims, to show that to support their argument. And what we found at that time is, certainly when we looked at initial jobless claims, the data did appear to support what they were saying. And today we want to look at initial jobless claims again, the most recent published data on that, which has come out since we spoke last week, plus advanced retail sales, which have also come out since last week. And this week's updated outlook for US GDP in the third quarter, which is the quarter we're currently in, which is released by the Atlanta Fed at the beginning of this week. So, initial jobless claims. If this was a natural disaster, according to our two researchers that we referred to in the New York Fed, what should happen is you should have a very rapid initial rise in initial jobless claims, and then over following months that would also decline pretty rapidly to a much lower level, say 4 or 5 months ahead. So that is exactly what is being shown in the initial jobless claims data that's now been released through the US Employment and Training Administration. And you can find a graph of this on the Federal Reserve Economic Database. So if you go to Google and type in initial claims, capital FRED, it'll take you to this chart called initial claims. And what you'll see there is that there was very rapid rise of initial claims from around about 200,000 at the beginning of this year, 200,000 a month at the beginning of this year, to an incredibly elevated 6.87 million initial jobless claims in the month of April. Now, if this is recovery from a national disaster, you should see these initial jobless claims fall away pretty rapidly. And that's pretty much what happened. That initial jobless claims fell in May and they fell in June. In the beginning of August, which are the most recent data available, was published by the US Employment and Training Administration. The level of initial jobless claims had fallen to 963,000, and this is down from a peak of 6.9 million. So over 85%, there's 85% decline in initial jobless claims since the peak. And again, that supports a view that this is a very large natural disaster rather than a recession. And that tells us that we can continue to expect a very, very rapid recovery from this crisis, and a much more rapid recovery than you would normally expect if you were recovering from a recession. Now, we spoke previously about advanced retail sales. Advanced retail sales data is collected by the US Census Bureau. And again, this data is available on the Federal Reserve Economic Database. You Google advanced retail sales, capital FRED, and what you'll see is the most recent numbers. The data is released in, I think, 6 different categories. You have advanced retail sales, retail, advanced retail sales, food, services, and then you've got advanced retail sales just retail and advanced retail sales just services. And this is available in both deflated by the CPI and as nominal sales, sales in dollar terms. And what we're talking about today is sales in dollar terms. That number, which was reported on the 15th of August Australia time, was for the month of July of advanced retail sales, retail and food services, was $536 billion of sales. Now, what's impressive about that is that the low in April was $413 billion of sales. So this number that we have now for July is the highest level of retail sales in the US ever recorded, and it is higher than the previous level before the crisis in February of $527 billion US dollars. So what we've seen in February, from $527 billion, there was the collapse of about 20% in retail sales, to April, down to $413 billion. And since then, we've seen a dramatic recovery to a new all-time high of $436 billion in July. This also fits the pattern of recovery from a natural disaster. But the most interesting to me is GDP now. GDP now is an estimate of GDP growth in the current quarter we're in right now, that's released every week by the Federal Reserve Bank of Atlanta. And you can Google GDP now, Atlanta Fed, to get this. And this is updated by them every week. And this is a really interesting number because about a month ago, maybe a little bit longer, I talked about an outlook provided by the Congressional Budget Office. And the Congressional Budget Office had a very strong recovery in the third quarter, and their very strong view, which was regarded as crazy bullish at the time, was that GDP in the US would grow by 5.3% in the third quarter. Well, it turns out they weren't bullish enough. The GDP now, released by the Federal Reserve Bank of Atlanta, released early this week, tells us that right now GDP is growing, US GDP is growing in the third quarter by an annualised growth of 26.2%. Now, to talk about that in our terms, that means the absolute level of GDP this quarter is expected to rise by 6.6%, which is even higher than what was regarded a month or so ago as the crazy bullish outlook provided by the Congressional Budget Office. I'll say again, as I've said before, this is overwhelmingly the fastest growth of any quarter since GDP started to be collected after World War II. It's interesting to look to the numbers behind that 6.5% growth in US GDP this quarter. There's a rise in personal consumption, and we saw that in the retail sales. But personal consumption is, in real terms, this is deflated by the CPI, is expected to rise by 6.9% in this quarter. And private investment, now, you would expect this to lag significantly, but even in this quarter, private investment in the United States is expected to rise by 5%. So what you've got is a broad recovery of both personal consumption and private investment in the US economy, rising to a US economy in the third quarter, which is currently growing by 6.6%. So we can come to the conclusion that the US economy is recovering very rapidly from this natural disaster. And we'll eventually be fully recovered sometime next year, but in a time and to a level which is much faster than you would expect in a normal recession and much more like what you would anticipate would occur in recovery from a large natural disaster.